Hey, Carl, thank you so much. I am joined by Marc Nachmann, who runs asset and wealth management for Goldman Sachs. It's great to have you here at Super Return. We should kick things off with private credit because that's been a big focus of the event today. And you all were recently in the headlines for raking in $21 billion for direct lending. That's on path to about $300 billion in private credit in 5 years. What can private credit do for Goldman, and what can Goldman do for private credit? Why is this a marriage that makes sense?
Sure. Leslie, thanks for having me. So private credit is one of our big asset classes in alternatives. We think we have a lot of expertise in the business. We started the business back in '96. And it was our first mezzanine fund. We're now on mezzanine 5, and we launched our direct lending platform in '08. And that's the platform that we just raised $21 billion for. So we have a very unique business. Not only are we veterans in the business, having done this for so long, but we also have a way of combining what we do on the investment banking side with our leveraged finance business there, with our private capital business. And so we tend to go to clients with both options and say, here's what the syndicated market looks like, here's where private credit looks like, and show people what the pros and cons are of the two, and then our clients can decide what fits most. And so we think that's pretty differentiating for us. And so we can offer both solutions to clients. And from an investing perspective, we see a lot of flow, and as a result, we can offer our investing clients great returns in our funds.
So I think it's important to point this out because so much has been made. There's this narrative out there that private credit is stealing from the banks, stealing business from the banks, and there's just this whole disintermediation in the industry. JP Morgan CEO Jamie Dimon was recently on the record talking about you-know-what to pay when the cycle turns for private credit, when you-know-what hits the fan. If this industry sours, are you worried that this asset class hasn't seen a true cycle at scale? And how do you think about traditional banking versus private credit if the cycle does turn south?
Sure. Look, I think in our business, given that we've been at it for close to 30 years, we've seen cycles, and we've seen cycles in the credit business, and our investors have seen cycles, and we're very mindful of it. And so in our direct lending strategy, we're very focused on large cap clients in defensive industries, good cash flows, non-cyclicals, for that exact reasons. I think there are a lot of newcomers who've not necessarily seen a cycle. Obviously, cycle will bring increased defaults and some losses in private credit. It's not a riskless asset class. But I think the interesting part about private credit is it is a pretty distributed model, and the actual private credit funds are not highly levered. And so from a systemic perspective, you actually have something that is pretty broadly distributed. So I think that some funds will perform less well than others. I think we will see dispersion over the next 10 years. We haven't seen much dispersions between funds over the past 10 years, given how benign the credit environment has been. But we'll see dispersions. But I don't see a big risk on a systemic basis.
In your seat, Goldman oversees and has under supervision about $3 trillion in assets. What are clients telling you about the current environment, the macro environment, and how are they shifting their allocations given just all the uncertainties out there?
Yeah, look, clients are asking lots of questions. I think one of the big changes, in a sense, is you're going to go into an environment where interest rates will be higher than they have been in the past decade or so. And so that has resulted in clients shifting assets into fixed income. Fixed income is a asset class where you can make good returns again. And so I think clients are asking, how do you think about portfolios in kind of this new environment where rates are probably going to be higher than they have been in the past 10 years? I think they're moving to fixed income. They're moving to private credit. We continue to see clients moving a higher percentage of their portfolio to alternative assets. I think we will continue to see people entering different alternative asset classes as we've seen higher returns in these asset classes. But I think that the mix between fixed income and equity will probably shift a bit.